right, in this video, we're going to be going over the core strategy of Pipsurfer, the wave entry. And with the wave entry, the concept of it is catching the best opportunities within market structure to catch trend continuation moves. So for people who don't know market structure is the way the market moves within a trend. So on an uptrend, the market structure is made up of highs and lows, but in an uptrend, it's made up of higher highs and higher lows. So you got a high, a higher low, a higher high, higher low, a higher high. So the idea with market structure is to catch trades within the trend at the higher low point for an uptrend. So that is your key area to take the trade, because you don't want to take the trade up here because the market can reverse and you lose the trade. You want to take the trade. Remember, you're still trying to buy low and sell high. So in market structure, you're buying the higher lows. For the downtrend, it's a series of lower lows and lower highs. The idea with a downtrend with market structure is to sell at the lower high areas. For new traders, figuring out higher highs and lower highs and lower lows and lower highs and higher lows, all those things can be confusing. So Pipsurfer makes it easy. Pipsurfer will detect where the trend is going and look for your higher lows to call your entry signals for buys. And for sales, look for the lower highs for sell entries. So as long as you have a trade that follows, you have an entry that follows a higher high for a buy or follows a lower low for a sell, you have a great entry. So let's take a look at some examples. So with Pipsurfer, what you want to do is, of course, buy after higher highs are created. So you have an example here. A higher high was created. See how the market structure indicator stays blue? That means that the market structure for an uptrend is staying true. So we have a higher high. You have a low being formed, and Pipsurfer gives an entry at the low. You would have took it somewhere in this bar. That was a 50 pip move. For a sell entry, you see here, you had a lower low be formed here. And you're just looking at the high after a lower low. You get the entry at this point here. You would have gotten that trade. This trade here was a 120 pip trade. Pipsurfer is designed to catch the lower highs and the higher lows. Now, you'll have examples where you may, on the first try, it may not go completely right. Like, even though this was decent, 20 pips, I wouldn't consider that a winning trade, even though it went up 20, 25 pips in profit, which is a great win for some people. But in this scenario, we have a second rule when it comes to the wave entry. We have the second chance wave entry. So what I mean by that is you have an entry that follows the rules. So we have a lower low created here. It had a high point being created. Pipsurfer gives an entry that wasn't a winning entry. What you can do under the second chance wave entry is, if the market, of course, if you lost that entry, that means the market pushed up higher. When Pipsurfer gives another entry, because it's designed to give a second entry to try to catch the move, if the first entry doesn't work, you have your entries right here. So for example, let's go with the first arrow. This first arrow here, you had a little bit of drawdown, but you still had 30, 40 pips in profit. That's a good trade. And that's not even a fully realized trade, but that's still a good trade. So the second chance entry, you can take a second arrow after the loss to catch the move, because you're going to get maybe a fake out, which was this. You thought this was the lower high that was going to create the lower low. You didn't get that. You got a better entry up here. See if I can find another example. So here's another example. You have a higher high that was created. You have a buy. The buy didn't work. But you have another buy here after this higher high. That's still valid. And look what happened here. You had a 70 pip move in your favor. So when you have those moves, it makes it easier because you know that, hey, if I lose this first one, I'll get a second chance at a better one a lot of the times. We have for the sell, you have a lower low being formed. The lower high after the lower low, you have a sell right there. This was a great trade. This trade here went 150 pips. Awesome trade. Obviously, that creates another lower low. Another high gets detected. Pipsurfer calls a sell. And you have a 50 pip move here. So you'll also have instances like this one, this next entry, where it didn't necessarily follow the rules. You had a lower low here, but the low before it was a higher low. So you have a higher low in this position. Then you have a higher high. Then the sell was called. You don't want to, even though this was a winning trade, a great trade, this was a lower percentage trade. So if you're being really conservative and you want to get the highest percentage trades, this wouldn't be a trade setup you take because it didn't create a lower low. Had this created a lower low before this, even if it was a higher high, that was still a valid entry because what's most important is a lower low being created before the sell entry. That's the most important thing. You may have deep retracements like this that go up a little bit higher than maybe some consolidation. But as long as the low was a lower low before it, that's where you have the good sell entries. Same thing for a buy. If you have a higher high before a buy, that's what's most important for buy entries. So this is the wave entry for Pipsurfer. Test it out on your account. So that covers the entries. So now for the trade management. The trade management, what you have is you have an entire array of risk settings provided for you. These risk settings are going to be based off of the volatility of the pair. Most of these pairs will be traded mainly on the 30-minute and the 1 hour. Those are going to be your best entries. Even though 15-minute, 5-minute provides great entries, believe the best entries from our testing has been the 30-minute and the 1 hour. So the trade manager will have an entire set of stop losses, take profits based off of great risk to reward. And we're looking for a 1.5 to 1, 2 to 1, 3 to 1 reward to risk. And that'll be automatically programmed into the risk manager. So with that out the way, if you want to do it manually, this is what you do. So for most trades, you'll have a reasonable area to pick a stop loss. So let's use this example, either one of these examples. So let's use the second arrow's examples. You see here, the second arrow, it was already a push down. It was the second bearish arrow after this high. You would have entered in there. Your stop loss could have either been a few pips above this last high, or let's say this arrow was above this candle. You don't really have a reasonable place right here for a stop loss. So what you can do at this moment on a USD CAD trade, which is a mid-tier trade, and you'll see the list of tiers, a mid-tier pair, you want to do about a 35 to 40 pip stop loss. This is on a 30-minute or on a 1 hour trade. And what you're targeting is at least 1.5 to 2 for your first take profit. So if you're doing a 35 pip stop loss, you want to target at least 55 or 50 pips for your first take profit to stay in a good risk reward. Your real target would be about 70 to 80 pips, which it did hit that. So your take profit one See if I can actually use this again. All righty. So take profit 1 equal to 1.5 to 1 or to 1 reward to risk, or 2 to 1 reward to risk. You want to get at least that before you start taking profit, because if you're taking profit before your risk is covered, your stop loss is covered, what you're actually creating is a negative reward to risk. This was a lesson in trade managing that it took me years to learn. But if your stop loss is 35 pips, and as soon as you get 10 pips in profit, you're cutting half of your trade, then what you really just did was take a 1 to 3 reward to risk. So for every $3 you risk, you make $1. You're not going to win that way. And that's why most people think they have to be 90% accurate to be profitable. With that type of reward to risk, you do. You do have to be 90 to 95% accurate to be profitable, taking 1 to 3 reward to risk. What you want to do, lower the accuracy that you need to be profitable and take secure profits after you cover your risk. That's how you stay profitable in the long term. That's something that most people will never teach you. So regardless if you're using a smaller volatile pair like Australian dollar, New Zealand dollar, and you're using a 25 pip stop loss, or you're trading a very volatile pair like GBP AUD and you need a 50 pip stop loss, you want to have at least a take profit that is greater than your stop loss, preferably at least by 50% greater than your stop loss. And that's how you remain profitable. Take profit 2, you want to at least be 2.5 to 3. I'm going to put that right in here. So take profit 2. This is what you're doing it manually. Remember, we'll have a lot of this stuff. So let me use another text box. No problem. So take profit 2 would be at least 2.5 to 1 reward to risk. So for every $1 you risk, your reward that you're seeking is 2.5 to 1. So that's what you're doing. Now, of course, take profit 3, you want at least a 3 to 1 reward to risk. So as long as you keep your reward to risk positive over your risk, you'll have a good experience trading, because your trading will have great risk management. So now you know the entry, and now you know how to do the risk management for the wave entry. So definitely follow the rules. People who follow the rules will have the best results, put themselves in the best position to win. So that's it for now. I'll see you at the next video.